Deflation is a term that often evokes concerns among economists, policymakers, and businesses alike. Unlike inflation, where the cost of living rises, deflation marks a sustained decrease in the general price level of goods and services in an economy. While this may sound advantageous to consumers, who may benefit from lower prices in the short run, deflation has significant long-term economic consequences. For a large, heavily integrated economy like China, deflation presents both domestic and global challenges that could reshape the landscape of the world economy. In the years following the 2008 global financial crisis, China's robust growth helped support the world economy, offering a lifeline when many nations were struggling. For over a decade, China's booming infrastructure projects, property market expansions, and rising consumer spending were seen as pillars of its remarkable economic story. Here's the GDP growth of China compared to the entire world, data published by the World Bank. As you can see, China has been growing much faster than the rest of the world. Without China, the global economy would have grown much slower. Several reports indicate that over the past 10 years, from 2014 to 2024, China contributed 30.9% to the overall growth of the global economy. This is followed by India, whose growth contribution is nearly half of China's at only 16.1%, in the United States at just 9%. This growth, however, has recently faced significant challenges due to an economic indicator called inflation. Recently, inflation has skyrocketed in many economies globally, ranging from advanced economies to developing ones. Here's a graph on the inflation rate, comparing consumer prices in East Asia and the Pacific to North America. You can see how quickly inflation rose from 2020 to 2022. This problem led central banks and monetary authorities to hike interest rates to ease inflation. But China tells a different story. China faces the exact opposite problem: deflation. Here's a graph comparing China's inflation rate to those of these economic groups. As you can see, China's inflation rate hasn't gone up since 2020. It has gone down, with the latest data available for 2023 showing an inflation rate of only 0.2%. That's far below the rate seen in the comparative groups. Let's take this further and look at China's inflation rate by month. You'll see that China's inflation rate has actually been negative or in deflation in some months of 2023 and 2024. The latest data available for November 2024 shows an inflation rate of only 0.2%. Why is deflation a problem? Deflation, simply put, is the persistent decrease in the general price level of goods and services. While this might sound like good news for consumers because it brings lower prices, there's a significant downside. Recently, President Xi Jinping was quoted asking, "What's so bad about deflation?" It's understandable to think that people would welcome cheaper goods and services, but there's a problem. When prices consistently go down, consumers and businesses may begin to expect even further price drops. This expectation can lead to delayed spending and investment, as people hold off on purchases or projects in hopes of getting better deals in the future. While this behavior seems rational on an individual level, it can have devastating impacts on the broader economy. One of the greatest examples of this issue is China's neighbor, Japan. Japan was once an economic powerhouse whose GDP nearly rivaled that of the United States. However, over the past few decades, Japan has struggled with deflation. Here's a graph on Japan's inflation rate, with data from the World Bank. From 2000 to 2020, the inflation rate was either negative, deflation, or just marginally positive, rarely exceeding 1%. This deflation has been a headache for Japanese policymakers who struggled to stimulate the economy despite implementing a variety of measures. The Japanese government introduced ultra-low interest rates, massive fiscal stimulus, and aggressive quantitative easing by the Bank of Japan, all in an effort to combat deflation. Deflation wreaked havoc on the Japanese economy, forcing businesses to invest less, stagnating wages, and keeping consumer spending subdued. Even with a strong industrial base and technological prowess, Japan's economy was stuck in a low-growth trap, a situation it is still trying to escape. The biggest problem deflation brought to Japan, and could bring to China, is debt. Over the decades, Japan has become one of the largest holders of national debt in the world. Here's a graph on Japan's gross general government debt, with data from the International Monetary Fund. China, on the other hand, has also seen its debt rise tremendously. Here's a graph that includes China, showing how quickly its gross general government debt has grown. The relationship between deflation and debt lies in the real value of debt and how deflation affects it. When deflation occurs, the general price level of goods and services falls, but the nominal value of debt remains unchanged. This means the real burden of debt, what it costs to repay in terms of purchasing power, increases. Here's an example to clarify. Consider a company that borrows 1 million yuan at an interest rate of 5% to finance its operations. As prices fall due to deflation, the revenue generated from selling goods or services also decreases, but the company's debt repayment remains fixed. This increases the effective cost of repaying the debt, which can lead to financial strain or even bankruptcy for businesses. Under normal inflationary conditions, a company might expect to repay its loan with revenue generated from the higher prices of goods and services it sells over time. However, if deflation occurs and prices drop, the company's revenue may decline, making it harder to cover both the loan principal and interest payments. The real cost of the debt effectively increases because the value of the money needed to repay the loan rises in purchasing power. Now imagine this scenario magnified across an entire economy. Businesses, local governments, and even households face the same issue. Their debt obligations become heavier in real terms. This can lead to a cascade of defaults as struggling borrowers fail to meet their repayment schedules. In turn, banks and financial institutions burdened with bad debts may tighten credit conditions, further constraining economic activity and deepening the deflationary spiral. For China, the risks are even more pronounced given the structure of its economy. The country's rapid development has been heavily reliant on debt-fueled investments, particularly in real estate and infrastructure. Local governments have borrowed extensively to fund ambitious projects, and the property sector has served as a key driver of growth. However, with property prices declining and land sales slowing, the revenue streams that once supported these debts are drying up. It's not just the Consumer Price Index, CPI, that matters here. China's deflation also extends to the Producer Price Index, PPI. Here's a graph illustrating China's PPI. Unlike the CPI, the PPI has been steadily declining over the past few years. But what exactly is the Producer Price Index? The PPI measures the average change over time in the selling prices received by domestic producers for their goods and services. In simpler terms, it shows how much money businesses are making from the goods they produce. When the PPI goes down, it means producers are earning less because they are selling their products at lower prices. This can happen when there is too much supply, weak demand, or both. So, what's driving China's deflation? It lies in three key factors. The first is weak domestic demand. Since the COVID-19 pandemic and the lifting of stringent restrictions by late 2022, consumer confidence has not fully rebounded. Households and businesses that experienced economic strain during repeated lockdowns remain cautious, saving rather than spending. Here's a graph on China's consumer confidence. Since early 2022, consumer confidence has remained low, largely due to the property sector slowdown in recent years. China has faced a property crisis. The property market, once a main pillar of growth, has been under strain. High-profile property developers, like Evergrande, have faced liquidity challenges. Here's a graph on China's real residential property prices. As you can see, house prices have continued to plummet, levels not seen since 2015. When house prices fall, it creates a ripple effect throughout the economy. Property developers struggle to meet financial obligations, leading to halted construction projects and layoffs. Homeowners feel less wealthy, reducing spending on other goods and services. Local governments, heavily reliant on land sales for revenue, face financial strain, limiting their ability to invest in infrastructure or public services. This combination of factors contributes to weak domestic demand, reinforcing deflationary pressures. So, is China doing anything to fix this? Yes, they are. In September 2024, China rolled out a broad stimulus plan that included a massive $1.4 trillion program to help local governments deal with their debt. Additionally, monetary authorities have continued to push interest rates down, making loans cheaper. During the Central Economic Work Conference, President Xi Jinping pledged to increase the fiscal deficit target. This means the government would spend more than it earns, borrowing funds to stimulate the economy. However, China's policymakers are steering away from their traditional strategies of relying on infrastructure projects and property market expansions to boost growth. Recent years have shown these methods are not sustainable in the long run. President Xi Jinping is focusing on transitioning the economy toward new drivers of growth, such as advanced technologies and innovation. As a result, recent stimulus measures have been moderate, leaving investors uncertain about the economic outlook. This uncertainty is reflected in China's 10-year government bond yield. Here's a graph illustrating this trend. The yield has dropped substantially, which is significant because the 10-year government bond yield serves as a key indicator of investor confidence in the economy. When yields drop, it often signals that investors are seeking safer assets due to concerns about economic growth. A low yield also reflects expectations of prolonged economic weakness, as it suggests that the market anticipates low inflation or even deflation in the future. And that's the latest on today's top stories. What are your thoughts? If you'd like to dive deeper into any of these topics or explore related issues, feel free to leave a comment. Thank you for tuning in and spending your time with us. Stay informed, stay curious, and we'll see you next time. Take care.